Insurance agents from around the world, welcome to the Insurance Guys podcast. My name is Scott Howell, your fearless host and leader, insurance agency owner and insurance evangelist for I Protect Insurance and Financial Services, based out of Huntsville, Alabama. And before we get started on today's episode, please help me welcome. He is a 6'3" sophomore from Mobile, Alabama, parade first team All-American, Rivals 5-star recruit. He is a fantastic insurance agent and a great American. Ladies and gentlemen, please put your hands together and welcome the incomparable Mr. Bradley Flowers. How are you, Bradley?
Fantastic, Scott. How about you?
Doing well. Hey, Bradley, I've got something up before we bring our all-star guest on today. I had something I wanted to go over with you. Now, I've been saying this for years. Insurance industry in the United States of America is the only reason this damn place doesn't look like a third world country. Catastrophic events, hurricanes, wildfires, tornadoes, you name it, we got it. And, you know, I've said this 15 times on the podcast. If it wasn't for insurance, it'd be a big damn problem for a lot of reasons. It is the reason, in my opinion, that the United States of America is as prosperous and people do as well as they do. And I'm about to prove that out to you. And the way I figured this out is, unlike everybody else in the insurance industry who books are like kryptonite to them. They can't read magazines. They can't read industry magazines. We can't be bothered to do all that because we got to do shit like take the kids to baseball practice, and we got blah, blah, and I got this, and I got to go home and watch Bachelor Paradise, and I ain't got time to read. Okay, nobody's got time to read, so Uncle Scott's gonna do it for you. Here it goes. Now, these are statistics that I have been looking for, and I'm about to tell you where I found them, Bradley. I found them in our friend and great American Troy Coursegarden's magazine, Insights. Spent about an hour reading Insights magazine last night. Are you ready for this?
Sure.
Here it goes. I've been insurance agents from around the world. I've been looking for these statistics for years, and I even brought this up on a previous podcast about 4 weeks ago. I said, every time I go to a country, I always think to myself, I wonder if these son bitches have insurance around here, right? So here's what I'm going to tell you. We're going to call this the cycle of prosperity. There is a direct link to property and casualty insurance in a country versus the level of prosperity in a country. Let me explain. So P&C insurance as a percentage of a nation's gross domestic product. Now remember, the poorest countries in the world practice self-insurance. In other words, they don't have insurance. About to prove that out in just a second. So here we go. The United States of America as a percentage of gross domestic product. Now, let me explain what that is, because if a lot of y'all listening to this are like me, you got an 8th grade education from a public high school, and all I learned how to do when I was in high school was drink beer and chase women. I didn't learn nothing else, okay? So people like Aaron Robertson, Scott Howell, those kinds of people, we don't even know what gross domestic product is. Well, here's the great thing, guys. You've got Uncle Scott here to teach you real quickly in simple, common language that a squirrel can understand. Aaron, take notes. Here it goes. The gross domestic product is the monetary, let me say that again, the monetary or dollar amount value of all goods and services purchased by the end user in a given period of time, okay? So in the United States, P&C insurance is what percentage of gross domestic product? Go ahead, brother, guess.
No idea.
Guess.
20%.
9.3%.
Okay.
Of the United States' gross domestic product. Again, that's the monetary value of all goods and services purchased by the end user. And by the way, gross domestic product of the United States of America, we are the biggest and the baddest when it comes to buying shit. Americans will buy shit. We prove that out every day. All right. Who's number 2, Bradley? Take a wild guess.
Canada.
4.7% of Canada's gross domestic product is P&C insurance. Those are individuals purchasing insurance. Number 3. Down under.
Australia,
3.3%. And then it drops off a cliff. Russia, 0.7% of their gross domestic product. Folks, if you live in Russia, you are self-insuring. China, 1.8% of gross domestic product is P&C insurance. Mexico, everybody's been to Mexico and you wonder, do these some bitches have insurance down here? 1% of their gross domestic product is insurance. I have just proven out, ladies and gentlemen, that prosperity, the cycle of prosperity, is tied to the people in that country having insurance. Now, there is one country that I could not see, but they were at the same level as the United States, and it blew me away who it was. Would you like to guess who that was? I couldn't see what their percentage was, but they were the same color. No, Dubai.
Yeah,
Them
I
sons
believe
of
that.
bitches in Dubai are insuranced up. Because the bright red color, which we were the only country that had that, which was 9.3%, Dubai was the only other country, I believe it was Dubai, it was somewhere in the Middle East, and it has to be Dubai, was the only other country that had that bright red, big time gross domestic product. Now, I don't know what their percentage was, but pretty high. And it's funny because when I talk to people like Chris Ball that sell insurance internationally, they talk about going to Dubai. Yeah, I just got back from Dubai. I was over working on a deal. Anyway, guys, thought you guys would find that very interesting. I have always wondered that, and here now we know the answer. We got an all-star guest on for you today, guys, and I'm going to go ahead and bring him on and give him the introduction, hopefully, that he's always deserved. He is originally from Meridian, Idaho, and he is a graduate of Boise State University with a BA in political science and government. He was in the Coast Guard for 4 years prior to getting involved in the insurance industry. And prior to founding his current position, he's the founder and CEO of SRA 831B Admin and has over 25 years of experience within the risk management industry. With a steadfast commitment to empowering trusted advisors and entrepreneurs through innovative risk solutions, he's been a guest on more than 75 podcasts in a myriad of industries and has presented at conferences across the country. He has also spearheaded SRA to new heights, earning a spot in the Inc. 5000, among other prestigious awards. Ladies and gentlemen, it is my profound honor today to introduce to you first-time guest on the IGP, Mr. Van Carlson. How are you, Van?
I'm great, Scott. Thank you. Great listening to you guys.
Van, what did you think about what I just talked about? Tell me your take on that.
No, I think insurance definitely creates commerce. I mean, you wouldn't take the risk, right? That everything.
100%.
Life is always about risk reward, and if the reward's not greater than the risk, then why are you doing it? And so I think absolutely, it's one of the things I've been concerned about the last couple of years, given the current insurance market we're in. Going on with rates and exclusions and all that stuff, and it's concerning, honestly. I don't think anybody's even talking about it. I'm glad you're bringing it up because I don't think Congress is even looking at it. Nobody's without proper insurance, affordable insurance.
Yep,
is hard to be a prosperous country. It really is, and we're in a weird situation right now. I never thought in my almost 30 years of being in this industry I'd ever see the state of the market it's in right now. And I don't know if it's going to get better anytime soon.
So let's drill down to what you just said a minute ago about it being one of the keys to commerce in the United States of America. I have never agreed with something more. And the reason I call it the cycle of prosperity is if we were Russia, 0.1% of our GDP was people buying property casualty insurance, who the hell's going to have a new car? Because the only way you're going to buy one is you got to save up to buy it because ain't nobody going to loan you money for one. If there's no insurance to back that $87,000 Ford F-250 that you just bought, nobody's going to do that. So now you got to save up to buy a car. And then same with a house. You want to build a $300,000 house, but you want to not have insurance on it. What idiot would back you to buy, and so you could have a reasonable monthly payment, a $300,000 house? Because when it burns down, let's just burn it down. You're never getting that money back from them.
Well, it's a good counter argument to the insurance is a scam crowd.
100%.
Which, due to the TikTok, Twitter culture we're in right now, seems to be louder than they ever are. And I think property and casualty sometimes takes a bad rap on the coattails of the health insurance industry.
Right.
But that crowd is still there tremendously. And that's a really good counter argument to that with actual data.
Absolutely. And you know, Bradley and I have always joked about becoming the insurance commissioner of the state of Alabama. So I went down to Montgomery one time and met with a group of like 25 or 30 agents. The state insurance commissioner gave a 20, 30-minute presentation. And the very first thing that came out of his mouth, he said, guys, I got to tell y'all something. He said, do you know, I know you guys are all P&C agents. He knew who his crowd was. He said, do you realize about 80 to 90% of what I do is dealing with health insurance?
Mm-hmm. Was this pre-Affordable Care Act?
A long time ago. This was, I don't know, 2013.
Imagine now with the Affordable Care Act and all that.
I can't imagine it. But, Van, I do think there's some factual numbers in there that back up what I've always said. And Bradley loves to say this, and I'm backing him up 1,000%. Do insurance carriers make stupid mistakes? Of course they do. Do they deny claims that should be paid from time to time? Absolutely. But overall, I'm painting with a big brush here. Hurricane comes through Mobile County this fall. 3 years from now, this place is going to look like brand new. And you know who's going to pay for it? The damn insurance industry. That's who's going to pay for it. And if it wasn't for insurance, this place 3 years later after a hurricane would look like a damn third world country. Windows would be blown out of everything. Streets would be deserted. It'd look like one of those old-timey old West towns that's like a ghost town.
Yeah.
You know? Anyway, I didn't mean to get off on a tangent. I'm sorry.
I appreciate your passion on it. Like I said, I've said for a long time. I mean, self-insuring risk there's a lot of risk involved in that, and it's kind of where I've gotten into where I've kind of evolved my professional career with risk management. Sure. At the same time, I don't begrudge what insurance companies have to do. When I was selling traditional insurance, I'd get somebody going in there and say, well, I never had a claim. Why am I paying my insurance? I'm like, well, do you really want to have a claim? Is that what you're wishing? I mean, because, it's a bad day. The best thing you do is buy an insurance policy and never use it, right?
Absolutely.
And that aside, at the same time, not only does, to add to our risk reward thing when it comes to buying a piece of property, be able to insure it properly, be able to get proper financing for it. Mm-hmm. The bank's going to give you a loan now because you got a good insurance, you got good credit and everything else. And then there's a tax incentive side of things as well. And I'm also in the camp. This might sound really weird. Is I think our tax code has also driven wealth in our country. Insurance has preserved wealth,
right?
But tax codes have created incentives to take on more risk. 1031. Look at commercial buildings today, right? If you didn't have a 1031 exchange format, would you really want to sell your building? Would you want, all those things? So we're in a really unique. Not only are we in a unique country geographically and everything else, just the way our economics are set up. When you drill down on it, it's glassed over pretty quickly, especially with insurance, right? It's how many times it's the devil's advocate, right? I mean, it's like right there with the attorneys, right there where you got to have an attorney, you got to have insurance. But, but also I would say too, the way our tax codes are written, as complicated as frustrating as it can be, it has created absolutely the risk reward as well. And so that's where my two worlds kind of come together, doing what we do. But
Well, it's interesting to say that the tax code encourages commerce. I think about this building that we're sitting in right now was purchased 3 years ago, and I'm very familiar with the building, and I know about what the cash flow is on the building. And a couple months ago, I started doing the math on it, and I was like, these guys aren't making any money on the cash flow based on what they paid, but it was a 1031.
Right.
So it's a perfect example of, hey, they would not have bought this building, and this other party wouldn't have made a ton of money, and then they probably 1031 that money.
it stabilizes. It stabilizes prices of buildings. That code. And I'm with you. And then they get the depreciation on it as well. So that's
exactly.
You're not even seeing that on the backside necessarily. So no, I know people get frustrated with it, but I would tell you that I do think it's created a lot of wealth in our country uniquely. And maybe that almost sounds like an oxymoron saying that, but if you create enough risk and the reward's great enough, people will do it. That's one thing Americans will always do. We will take risk, but the reward's got to be there. And if we have the chance to get the reward, then we'll go do it. And if we don't, then we don't. And getting back to your point earlier about insurance, it's somewhat I'm a little concerned about the future when it comes to properties and being able to insure those on coastal properties, forest areas. Are they going to start to lower the values of those properties because they're not able to obtain affordable insurance?
Right.
There's not enough competitors in those places to get insurance. That's another great example of you want stabilization of pricing, and if you can't get it right enough for insurance, it can bring the value of those properties down. I think you're seeing that already in parts of Florida, quite honestly.
Yeah. Well, too, so I met a couple months ago, I met with, coincidentally, who ended up is going to be the next governor of Alabama. And the thing I talked to him about was Mississippi passed a law where an insurance company can't deny you or non-renew coverage based on the age of your roof. And the point of that, and that's one of those things, and what I told him is like, look, it's one of those things that the outside looking in, it's like, oh, this is good for consumers. But when you don't allow when governmental regulation does not allow the insurance companies to effectively spread risk, it's going to have a net negative on the consumer, because what you're going to have is less insurance companies are willing to do business in that state. They're going to go to states where it's easier to do business. You're going to have less of a supply. Therefore, your prices are going to go up.
Oh yeah.
And that's where what worries me more is the government trying to step in those situations and meddling in it not being good for the consumer.
We have the same thing going on where I'm in Idaho. At 20 years and older, it goes to ACV. Well, that's a great way to legislate your way out of competitors. And what about the person that just replaced the roof? Took the responsibility. They got a 25-year-old roof that today is deteriorating. I'm going to go ahead and replace it. But they got to subsidize the person down the road because they chose not to.
Right.
Correct.
But they have the same coverage that they did as if it was a brand new roof. Those are just politicians that people were in their ear and they felt they were, hey, we're really here for a champion of the consumers of insurance.
Yeah.
Long term, they're hurting them, and they just, but it's a feel good thing kind of today. I'm sorry to hear that they passed legislation like that, but that is just a politician that doesn't understand business, honestly.
And my point is, hey, look, we're used to hearing this, and this was what he's pretty far right wing, and this is, I think, what hit it home. As I said, hey, look, I'm used to hearing stuff about like crazy laws like this in California, but Mississippi is a little too close to home, and we don't want Alabama to become California. And that was like the home run right hook, like, oh yeah, absolutely. It was like that was the thing that got across. But yeah, it's scary. Some of the stuff's going on. My agency operates only in a coastal market. That's all we do. Yeah. And in some ways it's easier, in some ways it's harder, but it definitely is scary for sure.
Hey, Van, let's get to the getting now. We brought you on this podcast because we felt like our mission is to help insurance agents any way we can. And what you're doing over at SRA is very interesting to both Bradley and I. And we felt like the agency force out there, independent and captive agents out there, would want to hear more about what you guys are doing over there. Can you just get with the getting for me for just a minute and talk a little bit about kind of how you kind of got to where you are today, and talk a little bit about what SRA is.
Yeah, you bet. So I was, traditional market. I was actually a captive agent for Farmers Insurance going into '08, the Great Recession. And,
good time to start that, I'm sure.
Yeah, good time to start any company was in '08.
Yeah.
If you survive that, there's a good chance you're going to get at least past the 10th year. But no, it was one of those things where, it became a glaring event for me where the financial risk business owners took. We want to be good there for our clients. We want to make sure they have the right policies, the right coverages, the right limits at affordable prices. And at the same time, it was kind of disheartening when, when they took accelerated depreciation on, and I always joked about this, but it's true. The fourth quarter was great for me too, because if I had business owners, especially subcontractors, general contractors, guys that were really good blue collar business owners, quite honestly.
Right.
They make $1, they spend $1.10. It's just their nature. And they drove a lot of the commerce we talked about earlier. The thing is they go meet with their accountant and say, hey, I had a good year. Van, what's going to cost for another 2 pickups and it's another skid steer to insure? And we insured them, and the thing was great. Well, all they did was bet next year was going to be better than this year, because they took accelerated depreciation, but then they financed the equipment. And then here comes '08, '09 along, and unfortunately, covenants and loans started to mean things. And banks have a responsibility to do what they got to do too, right? They got to they got to make sure the bank's solvent, and they're going to do what they can to make sure that they do that. And they unfortunately saw a lot of my clients get auctioned. The equipment was being auctioned off, and their businesses were shutting down. So then that's really kind of hey, I'm not really handling all their risk. Right, I'm handling the intangible assets of the business. I'm doing those types of things where, if you can put a loan on it, I can get a good insurance policy for you. But what about all the intangible assets of the business? One of the biggest ones being the cash flow. There's business interruptions, of course, on policies, but you got to have a triggering event, and they got to be a direct triggering event, right? I mean, we all know that because of COVID at this point in time. Fast forward to COVID is a whole nother concept. But the idea is wrapping this up in the ability to take the financial risk a little bit down lower off the business owners is where I kind of got involved. I knew about the 831B tax code. So the 831B tax code is really the ability to own a small insurance company for tax advantage purposes. Now, that was introduced in 1986 Tax Reform Act, which I'll just say right now, I was still in high school when that came out. And looking at you guys probably were maybe fifth grader. No, let's see here. Kindergartners, maybe?
I think Scott was in college.
I was right behind you, brother.
Really? Well, damn.
Yeah.
You've aged well then, man. Look at you.
Thank you. Like fine wine. Go ahead.
So 1986. So, that's when the Reform Act came out. And that's really when crop insurance was coming on pretty hard. Meaning this, crop insurance was not federally backed by it is today, but it was private insurers were getting out of the market. It was too catastrophic, not profitable. We're getting out. So Congress got together, said, hey, let's create an incentive. And the incentive basically said, hey, we'll still allow you to take a deduction at your operating company level as if you bought a crop insurance policy, but we're going to put it, and and as long as you can, you're forming an insurance company, which has to look and feel like an insurance company, the box does, and you elect that under this 831B tax code, the premium you put into it would not be considered taxable. So now you're taking a deduction at the operating company level, and now you're moving into an 831B tax. You're able to make it's a C corp. Take the deductions. The premium stays inside the C corp. Think of it very similar to a 401k, right? I'm expensing contributions as a business owner. I'm expensing premiums as well. But because I have this self-insured risk, Congress said, hey, we're going to allow those dollars to build up, create surpluses, and as time goes on, you're going to handle those risks more effectively and efficiently, because the private market is not either affordable or not attainable type risk that you're having. And crop insurance kind of drove that.
Right.
Now, fast forward almost 40 years later, you've got a lot more we call enterprise risk management today, right? Where insurance companies, again, the tangible assets they're doing a great job on, but the intangible assets, they're not so much, like brand protection, intellectual property, supply chain risk, dispute resolutions, I think I mentioned brand protection. There's several out there that we talk about that we are absolutely holding on to on a self-insured risk basis. And one of those things we talk about with risk financing, right? If I risk finance something, I'm going to go buy an insurance policy. I'm going to buy an insurance policy from you guys. I'm going to transfer that risk for my commercial building for fire, theft, vandalism, hail one, all that stuff. But there are some things I'm going to retain on my own. One is ACV now, actual cash value, right? I may not get replacement anymore on my buildings, or I can't, or the capacity has been met, and they're not going to give me any more coverage for my building. I mean, we're seeing that all over the country right now. Or I may have more co-insurance deductibles because I got hail coverage, or I
Right.
got wind damage co-insurance. So now I'm taking on a lot more first dollar risk, even though I have traditional insurance policies. That's also an unfunded liability as well. And then, of course, when I meet with business owners, we just try to educate them on this part of it and say, hey, you have an unfunded liability. You can't transfer it through normal channels like paying a premium and transferring that to a large insurance carrier. You're going to retain some of this on your books. How do you want to risk finance it? Do you want to use pre-tax dollars or after-tax dollars? If you want to use pre-tax dollars, just keep doing what you're doing. And God forbid if something happens, it's either going to be pulled out of cash flow, your own personal savings, line of credits at banks, and all that kind of stuff. Right now, that's how that's handled today. Or do you want to use pre-tax dollars, still take the deduction at the operating company level? No different than if you bought a piece of equipment and still dump it into an 831B plan, but now you have those dollars on a tax-deferred basis to handle the first dollar risk and also some of this enterprise risk management risk that we're talking about. To go really full, one of the ways we're handling today with conversations is fairly simple, just saying, hey, if you relied on PPP, ERC, and all these other government programs when COVID hit, what are you doing differently today? Can you really expect that to happen again? And nor should you expect that to happen again, what the government did and stepped in and everything else. So yeah, I mean, we're having, this is risk management at maybe at certain different levels, but at the same time, like I was saying earlier too, I mean, my clients are risk takers. They're conservative by nature, and they're very, very good business owners. And it disheartens me when I sit in a meeting with a very good entrepreneur, great business owner, gets it, does a great job. Man, I'm done. I don't want to grow my business anymore. Why do I keep doing more when I just give Uncle Sam more of my money, and all the risk I'm compounding in the back room makes no sense for me? And that's not good. That also hurts our ability to create commerce. We need those guys out there creating those tidal waves out there of opportunity for not only for themselves, but for their people that they hire and all that good stuff too, right? So those are things that, I get pretty passionate with, that we're not here for everybody by no means, but I think for the right clients, the clients that understand the risk reward factors, I think that what we offer is a great tool, but that's all it is. It's not a silver bullet by no means. And unfortunately, I would say in the beginning of this, it was more risk financing, managing the risk financing. But as time has evolved, especially since COVID, and now the current insurance market we're in, it's more and more about managing the risk on the back end. Our business owners have achieved to a certain level where maybe they're not, gung ho so much, or they're not putting every dollar back in their business. They're trying to manage risk now, right? I mean, you at some point, as you evolve in any business, risk starts becoming in, the little thing in the back of your mind you've been ignoring starts to come more in the forefront. And that's typically who we work with around the country. And we're the largest manager of these plans, and we call ourselves an 18-year overnight success story. But I'm really happy to be where I'm at in this world of risk management. I think what we bring to the table, and clients have said this to me, Van, I just sleep a little bit better at night knowing I've done your plan, and I've got these dollars offset off to the side for all these that have come up in my own experience being a business owner long enough that I've had to either take it on the chin or work with it, somehow get through it. But now I've got this reserve set aside. It makes me want to go out and take more risk, and that's a good feeling to have as a risk manager for business owners.
So you mentioned the IRS. Talk a little bit about the lawsuit.
Yeah, so we've had the pleasure of, when you're out promoting a tax code called 831B, like anything else, any tax incentives out there that Congress creates, and you're good enough at it, you'll eventually bring the attention of the IRS. And we got our promoter audit, they called a 6700 promoter audit, August of 22. And last year, June of 24, they shut it down. They sent us a letter saying, hey, we're not going to examine anymore. Don't read anything into this. That cost me just to voluntarily comply with the request for information, cost me over $300,000 as a company. Then we also asked for private letter ruling. Started that process in 2015. Last fall, they came, and after spending about $70,000 in legal bills, and we wrote them a $30,000 check. So we have to pay for their legal part of it to go through the private letter ruling to say, hey, are we doing everything right according to what the code is designed for, blah, blah, blah. Last fall, they chose not to give us a private letter ruling after, I want to say, almost 7 years in and out with them. They would call us up, they would send a thing to my attorney saying, hey, we need a response on this. We got questions regarding this, because you have to do this. If you haven't done, I wouldn't recommend anybody go ask for a private letter ruling. It's a lot of headache, but there's a lot of details. And they would ask for a question and say, hey, if you don't get it done in 2 weeks, we're going to consider this resolved. And of course, we would have to respond, and then we wouldn't hear from them for another 6 months. And then last fall, they went ahead and shut it down on us and said, we're not going to give it to you after a lot of legal bills. And anyway. And then in January of this year, they threw down new regulations on us that made it harder for us to do business, quite honestly. It wasn't designed to really bring more taxpayer confidence to participate in these programs or not. It was really to scare people from doing it. It's called illicit transaction or transaction of interest. And after all that, after us going through their audit, not really getting a thumbs up, thumbs down, but we're just going to shut it down. The private letter ruling, we've talked with enough attorneys. We actually hired the Troutman firm out of Georgia to represent us in court, and we decided to sue the IRS over it. I had a business owner out of Texas join us with that lawsuit, and just trying to get to the point where, like, enough's enough. This is a legitimate code passed by Congress. It's absolutely backed by Congress. They actually they made some changes to it in the PATH Act in 2017. They increased the ability to put more money in it, but they got around the estate tax place. And if you look at the court cases that IRS is still going after, it was sold for estate tax planning, not for risk mitigation. And most of our competitors in this space, guys, is CPAs and is estate tax attorneys. And I tell business owners all the time, it's no different than, could you imagine an attorney trying to sell their business owner insurance? But essentially, That's what they're doing. Sure. And they know the tax code, but they don't know risk management. They don't know insurance. They would never even bother to take the time to read an insurance policy. And meanwhile, they're trying to talk them into this kind of a thing. So there's alternative reasons I tell people Boston Tea Party is a real thing. I mean, we don't want to pay any more taxes we need to. We want to pay as little as we can, right? I mean, it's our DNA. It's funny. I travel around the country and around the world, and I'll never forget this one guy. I work with Lloyd's of London a lot because we got to use reinsurance markets on some of our clients and stuff. And he's like, I love you Americans. He says, you guys go to a cocktail party, you brag about how much money you saved in taxes. He said, I go to a cocktail party in London, and everybody brags about how much taxes they paid. And those are very big different mindsets that we have. But anyway, but that's really where the IRS kind of, we just said enough was enough. And we think, there's some good things lining up for us. We've been involved in the lobbyist group now called Minicap for 3 or 4 years now. We're getting good traction in Congress on this code. And, honestly, there's some court cases coming out all the time. There's some really bad decisions were made, and there were some good decisions, but they're polar opposite of where they need to be. So there's some things going on inside the different court systems, that there's different judgments coming out right now on this code that makes no sense. So it's all coming. I think it's all coming to a head, quite honestly, and it's mostly has to do with what the insurance market, where the state of the insurance market is today. Also, at the same time that business owners have been hit pretty hard. Small business owners have been hit pretty hard since 2008. It's not easy to be a small business owner today, and yet it represents almost 70% of employment in the United States. And so I'm worried. What I see a lot of merger acquisitions going on around the country. I mean, there's just scary statistics being thrown around. There's over 3 million small business owners right now that are in their high 60s, low 70s that are still owning businesses. and they really don't have a way to sell their businesses. You're getting some of them doing it, but the risk reward thing has to be there. It has to stay there. And I think we add to that ability for the reward, but also mitigating the risk at the same time, which affords you to take the reward, right? So that's kind of where we fit in with our business owners. And I think, through a lot of hard work and quite honestly, perseverance, we've been able to rise to the level we're at today as a company. And we're helping over 1,200 operating companies right now around the country. And hopefully by the end of the year, there'll be another 200 on the books. But we're getting a lot of phone calls. And tax incentive aside, it really has to do with risk management, quite honestly. People are losing sleep right now on what their insurance program looks like. And is it affordable for them to even maintain it? And two, are they worried about turning in a claim right now? I mean, it's a weird market right now, honestly.
Yeah. I'll tell you a funny international tax story. I went to Cuba in 2019, and we hired this tour guide to show us around for the day. And her and her husband had some kind of business. I don't remember what it was. And their tax rate was just unreal high. I don't remember. I want to say it was like 90%, but it may have not been quite that high. And she was explaining it to us, the government's your partner, et cetera, et cetera. And she's like, we have to pay this percentage. But so we just hide it. And I said, we do too. That's what we do too. It's like, it's just part of it.
So going back to something you said earlier that kind of caught my ear, as far as the 831B goes, I see on here it says, the things that can go inside the 831B: data breach, third-party interruption, dispute resolution, supply chain, warranties, and more. But if I heard you correctly earlier, where this thing got sideways, correct me if I'm wrong, could be wrong, was there were individuals out there over the years that used the 831B for more of estate planning purposes, and that was where the train ran off the tracks relative to the IRS getting involved and saying, we don't like 831Bs. We think they're, because that's kind of the feeling I get, is that you hear 831B to the IRS and they cringe a little bit. Is that, am I right about that?
No, you're 100% right. I mean, my experience with the IRS is get me once, don't get me twice.
Right.
And you're when you think about it, you're taking deduction at the operating. So here's what they would do, Scott. This is how it was sold by estate tax attorneys and life insurance agents. Take the deduction at the operating company level. We'll put it into an 831B. We'll have your kids or grandkids or irrevocable trust own it. So now you're devaluing your estate and you're transferring it over and you're getting around gift taxes. And we'll take those premiums and buy a big life insurance policy on you. Mm-hmm. You die, that's going to get received those with death. So now you're talking about life. You're talking about untaxable
planning.
Yeah, and death benefit comes tax free. So now these guys are selling tax free. And I, of course, always when I get around those guys, I'm just like, well, you must plan to live forever too, because you're going against the two golden rules of life. That's death and taxes. And you told me I don't have to pay them anymore. And so it's just to your point, it's too bad, and it's still going on out there. Quite honestly, it's frustrating, but. The IRS is kind of the one glove fits all type mentality, and you know what? We've been property and casualty agents long enough. We know there's bad actors out there in our industry too. Right. How old's our industry? Our industry is a super old industry. But we still got bad actors in that space. And so you're always gonna have bad actors. It's just when the government, instead of going after those situations, they put regulation in, or the one glove fits mentality, and it just affects everybody else. And it's too bad. It's what we deal with. And like I said, we've gone through their promoter audit. We've gone through, and that was stressful times. I mean, you don't know. I mean, you can get a rogue agent out there, man. You can go off the rails too. And so. But it was a decent experience. I just wish we had some resolve to it, and I'm sure our clients did too. But at the same time, we've been doing this long enough. There's some pooled risk you got to have. There's some, you got to understand insurance to be able to do this kind of program. And again, if you're in it to sell, alternative, create the money over here so we can have alternative reasons to go use it. we restrict clients what they can do with their reserves and their surpluses, and are you solvent enough to handle the risk you're taking on, and understand that you're going to pay claims unaffiliated to you, which means you're going to pay claims in other business owners similar to you. You may not have a claim this year, but your 831B will, guaranteed. And so they got to stomach that too a little bit too with the risk, right? So, but yeah, we'll see where it goes. I do think it's moving in the right direction, and Scott, you hit it right on the head. I think it's, the IRS, like I said, get me once, don't get me twice. And unfortunately, we had a lot of people trying to just do something that it was never designed to do. Congress could not foresee what went on with the 831B code, right?
So at the end of the day, do you feel like their denial of your letter that you were requesting was in an effort by them, somebody in that space didn't want to give you that leverage to be able to say, all practical purposes, here's a letter saying I'm doing this shit the right way.
Right.
And because they didn't want to give you that leverage, they're like, nah, you're just not getting a letter. Sorry.
Yeah.
I mean, is that pretty much?
That would have been, maybe it still would have pissed me off, but 7 years later, it's like, so it's, death by 1,000 cuts on that thing. And we just kept holding out hope we'd get it. Or at least they'd come back and say, no, we don't agree with it. We don't like this. We don't like this. And okay, we'll change it. But they didn't even do that, right? So one of the things that's really frustrated me, and it continues to frustrate me, and I'm giving some hope out there because there was a case overturned last year called the Chevron case, where bureaucracies were not given the benefit of the doubt that the law was being enforced the way Congress intended it to be. I don't know if you guys follow that stuff or not, but that happened in 1984, where basically the Supreme Court ruled that said, hey, federal judges have to give the bureaucracies the benefit of the doubt that they're enforcing the law the way it was intended to be passed by Congress. Mm-hmm. That tilted us to more of a bureaucratic state over the last 20, almost 40 years. I mean, meaning that, you remember the old adage, hey, pass the bill and we'll read it later? Well, right. Still Congressmen people weren't reading it. It was the bureaucracies that were going to have to enforce that bill were reading it, and they were interpreting it the way they thought it should be interpreted, not again for Congress. But if you challenged them on that and you went to court, the judge had to, basically the deck was stacked against you, that you would have to, that the judge would have to assume that this bureaucracies were enforcing it the way Congress was. And that got overturned last year. A pretty famous case. So what you've seen in the last couple of months actually is a big pivoting. States' rights are becoming more and more of an issue, meaning that states are becoming having more say in what goes on. Mm-hmm. And two, you're seeing the bureaucracies and federal governments, due to some slashing of budgets and everything else, kind of starting to lose power. Right. Also puts the onus on Congress to be true Congress. Pass bills, understand what they're passing, and get some work done in Congress instead of this constant status quo. Don't do anything. Don't pass these bills. If we do, we'll let the bureaucracies enforce it. And it just puts a lot of burden, especially if you're a business owner. It puts a lot of burden on you. I'm not just talking about the tax code. I'm talking about environmental. Regulation shouldn't make you feel like you're a criminal. Like you said earlier about height and stuff, right? I mean, they make so much regulations, and you're like, how do I even follow all this stuff? And it almost makes you feel like I don't want to be a criminal, but it's starting to feel like I'm hedging around all this stuff because it's gotten so damn complicated.
It's purposely It's almost like it's purposely complicated so that they can catch you doing something.
Exactly. It's like reading fish and game regulations. Sometimes you're like, okay, what area am I supposed to be in today? How good's my tag? And so it gets to the point where it gets super complicated, and that's one of the things we don't want to do with our business owners. I mean, we don't try to complicate their lives on doing our program. I think I would say one of our biggest core competencies as a company is manage insurance companies. We currently manage 800 of them. Now, of course, they're privately owned insurance companies, but we manage them from the financial reportings, making sure that they're meeting the litmus to the four-part test. The policies are being underwritten in a way, the claims are being adjudicated. I mean, that's what we do as an administrator. So we administer those plans for the business owners. No different than you would hire a 401k to administer your 401k plan. You don't want to do that yourself.
Hey, I got one last question. I gotta ask you this. So how many did you say you're managing?
800.
800. Okay. First dollar in, this program, but then you've got that layer somewhere in the mix, and I'm sure it depends on the size of the company as well, right? Like when I say first dollar in to pay claims, let's say for easy math, it's up to $500,000, or maybe it's $1 million, maybe it's 10 million. Where the reinsurers are coming in behind is they're taking that next layer, or maybe the third layer. But between that reinsurer, am I right about that? That there's also that reinsurance component? Because if I'm running a company and I'm doing it the right way, and I want to set up an 831B and kind of in a roundabout sort of way, like you said, become my own insurance company, that's great and grand. But I don't want to be on the hook for all this shit. If it's a 100%. Wrongful death claim and I get hit nuclear at $15 million. Bubba, I want to have somebody at $5 million that says, "Hey, Scott, you can stop. We're going to take the rest of this."
Yeah. So here's what I would say to you, and I tell business owners this: I'm not here to increase or decrease the risk you have.
Right.
I'm here to manage the risk you cannot transfer.
Right.
How do we use that tax deferred? But what you just referenced was we would call that a macro captive, right? Where hey, I'm paying $1 million in traditional insurance. I'm willing to take on more first dollar risk.
Right.
But then I got to have a stop. If you're familiar with health insurance, right? Self-funded health, it's a stop loss policy, right? So I'm on a specific deductible basically.
Right.
Before the insurance carrier kicks in, and then I'm also on an aggregate, right? So very similar to self-insured healthcare is macro captives work. So what you just described is absolutely. So if you have a runaway claim, we'd call them. You got a certain you're stopped at a certain dollar amount, right? And then the reinsurance carrier. So when I tell clients, hey, you're paying $1 million in traditional insurance through work comp, GL, and all that kind of stuff. What we're going to do is just cut out the frontline company. They're charging 40 cents on the dollar just to manage your policies and your risk. You now become that. You're now going to participate in that profit of that 40%, but the other 60%, you're still going to pay the same amount of money.
Sure.
Save money on the front end, but that 60% is still going to have to go buy reinsurance carrier premiums. We're going to deal directly with the reinsurance companies and go directly to them.
Correct.
And cut out the middleman is essentially what we're doing.
Do you have any admitted carriers or not admitted? Do you have any carriers, either admitted or not admitted, that are sitting in the middle of that between the reinsurer and the business owner?
No, what we do is we have a lot of people with 831B sitting in the middle of that, and that's what that risk was I was talking about. So there's 3 layers to that deal, right? So
got it. That's really cool. So what types of businesses does this type of self-insured micro program work the best for? Types of business classes. I've heard you mention contractors, pretty good sized contracting firms. Does it work at all for habitational type risk? Guys got 50 apartment complexes.
It does. It's getting stressed right now because of their property. The reinsurance markets aren't in a big hurry to increase risk of appetite for property insurance right now. But so it makes it a little bit tougher. But deals are being done. They might do a certain cap, and then we got to go out and build another tower somewhere else with other traditional carriers. But if the first, if they know, hey, if the traditional carriers are not on the hook for the first $5 million of losses, you're going to find a lot more appealing premiums out there for business owners to take. And so, most of it has to do with, I would say, the amount of premium you're paying and the attitude and the savviness of the business owner, quite honestly. Because it's one of those things that, that's why, to somebody that's doesn't like insurance, doesn't understand insurance, this thing can start to sound like a rocket ship real damn fast.
Right.
What things we try to avoid. So
give our audience, if you're a traditional P&C agent out there listening to this right now, and you've got a business that, hell, maybe you wrote it back when it was a mom and pop, when it was just getting off the ground, But hell, over the last 10 years, this thing's turned into a damn juggernaut.
See,
what are like three? I like the power of three. The three things that if I'm going to guess one of the three identifiers of a business that would probably need to talk to you, somebody that needs to talk to you, it's going to be revenue is going to be one. Because, out of the gate, if you're only making a Snickers bar and a pack of crackers, well, you don't have anything to talk about. Revenue's number one. What would two others be?
Revenue, risk class. I mean, the premiums obviously have been a big factor. And then, like I said, I think just as important is the attitude of the business owner. And is it a business owner that's gotten to the point where he's working on the business, not in the business? And,
sure.
and does he have time to think about these types of things? And that's, that's just I don't want to say maturity, but it's an evolution of the business. To your point about the mom and pop. I mean, I guarantee those folks that started that company, they didn't have time to look. They were just happy to have an insurance policy, paid it, and didn't worry about it.
Yeah.
Now they're 10 years later. You got a lot of revenue, you got a lot of business, you got a lot of risk on the books.
Yeah.
I mean, that's just. Here's what I'd also say to all your P&C guys: if they haven't dove into this thing, they better do it, because it's no different than the healthcare brokers that sat on the sidelines and didn't worry about self-insured health insurance either. The guys that adopted quickest to that won that market space. And I would tell you that the captive stuff is going to keep coming. IRS aside and all the other BS aside, this thing's going to become a normal business practice. Business owners are we're talking to congressional people right now about, hey, this should have been the PPP all along. Business owners should have been allowed to put away tax deferred basis on issues like this, to where you didn't have to go out and make up $6 trillion of money and the catastrophic events that have taken place since then. And maybe we still don't even know all the situations that caused yet.
Right.
Are we really going to do that the next time? What are we going to do the next time? What is plan B on this?
Last question. I got to go.
Yeah.
Of the 800 you got, what's your number one business class? Is there by far, this is the business class we see the most that wants to do this?
Medical industry and contractors.
What do you mean by medical industry? Doctors?
Surgical centers, medical doctors, dentists.
Yeah.
Doing a lot of stuff on that front, especially with audits, Medicare. There's a lot of gaps in their policies right now, unfortunately.
Right.
So those types of things. And then the contractor guys are just, they're not risk adverse, man. They'd be like, yeah, I got good safety programs. I got good training.
Yeah.
I'll take the risk myself all day long.
Yeah, I'll run it. Man, you're the best. Appreciate you being on.
Yeah, thanks, you guys. It was good talking to you guys.
Yeah, it was great talking to you too. I'm glad we had that conversation. I hope these agents, I hope they listened to that and really thought about that, because they may have, 2, 3, 4, 5 clients on their books that they're like, And I don't know how you partner with somebody like me. If Scott's got, I can sit here and think of 3 or 4 contractors on my books that I helped grow up with that might be a fit for you. But I don't know how you partner with independent agents like that. I don't know how you would partner with me, or if I just say, "Hey, Van, here's a candidate for you. Go get them."
No, we would definitely partner. I mean,
okay.
You have the relationship, we don't.
Right.
And we just have the expertise, and eventually you'll have that expertise too, quite honestly. So I'm not interested in, but I do think what I don't want to do is you had a long-term relationship, you don't bring an idea like to this, and then you get egg on your face because you didn't, because the other guy really did. And that's one thing I don't want P&C. Building relationships, as we all know, is not easy. And
sure.
These people do become friends, and you want to do the best you can for them.
Right. All right, I'm going to shut this thing down. Guys, you were listening to the Insurance Guys podcast. My name is Scott Howell. This is Bradley Flowers. And as I end every episode, rewards come from action, not discussion. Get your ass out from behind that desk today. Go out into the big bad world. Become the mayor of your village. Make money for your family, for your wife, for your husband, for your kids' college fund, for your parents and your in-laws out there like mine that are struggling. Go make money for them. Write good business for the agencies that you represent, and write good business for the carriers that you represent. Bradley Flowers, I love you.
Thanks, man. Thanks, Van.
Van, thank you, brother. Guys, you were listening to the Insurance Guys podcast, and we love each one of you. Thank you so much for being a part of our family, and we'll see you back here real soon. Take care.